Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. When you look at the application that you use to make investments in mutual funds, you see a snapshot of the returns that you get. Usually, this will be described as a portfolio return. And you will feel happy when it's in the green, of course, but you will also see what is called an XIRR. Now, if you know what this is, then very good for you. But I've found, just in a dipstick in my office, that a lot of people don't really know what XIRR means. What is internal rate of return? That's what it essentially stands for. So we're going to help you understand why this is a very important tool to understanding how your portfolio will grow over a period of time, and why this is what you need to go for rather than a point-to-point return, which is a lump sum investment. Of course, that is also useful, but we'll talk about why XIRR is important to track as well. Apart from that, we'll talk about a fact sheet. This is data or information that is shared by mutual funds on an ongoing basis. It is available to the public. You just have to go to the website of the mutual fund, and you can go and look at how your mutual fund scheme has changed over the course of a year. And there is a lot of disclosure, a lot of information in that. Of course, when you look at that for the first time, perhaps it can be a little intimidating because there's a lot of information. But we'll help you, my guest will help you identify how to read that fact sheet and what you should take from it. Finally, I would also like to talk to you about Parag Parikh Flexi Cap Fund. Now, of course, a lot of you invest in this scheme, and very clearly this is a scheme that has taken a cash call. It has actually doubled down on that cash call in November, I've noticed, based on the latest portfolio data, because actually their equity holdings have shrunk just a tad bit, and their holding of equity and debt has actually gone up. That's served them well. They've outperformed the benchmark, and they're actually positive since September. Of course, they're a very short time frame, but we'll talk about that and how cash calls have worked for mutual fund schemes in general. To speak about all of that and more, we've got Vishal Dhawan, Founder and Chief Executive Officer of Plan Ahead Wealth Advisors, in studio. Vishal, thanks as always for taking the time. Very basic topic of discussion today, but I think important nonetheless. Do you find that a lot of people understand internal rate of return?
No, actually not. It's surprising considering how powerful SIPs have become.
Yes.
And the power that an extended internal rate of return actually does in terms of accurately describing to you how much money you've made. I think it's just a area which requires a lot of
So for
attention.
those people that don't understand internal rate of return, let's now shift away from Greek and move to a language that they understand. How do you explain XIRR or internal rate of return?
So I think, you go back to asking yourself as an investor, how do I actually invest? So if you're buying a mutual fund, there are three ways that you've traditionally invested, or actually four, right? So one is you've put a lump sum of money one time, never bought anything else.
Yeah.
That's simple. You're just putting in money once, and maybe you withdraw the money after the next number of years.
Yeah.
The second is you do SIPs. And sometimes you just continue them forever. So it's easy because at least you know that you've been putting a certain amount every month.
Yes.
But the reality is that number is also changing.
Yeah.
You're going to increase that SIP. There might be a pause of that SIP. You might decide that I need a part of that money because I'm traveling. So there can be different inflows and outflows happening from the portfolio. The third is that you could have done a systematic transfer plan, moving money from a liquid fund to an equity fund. Or you could be using it for cash flows through a systematic withdrawal plan. Now, in all of these cases, the amount of money that is actually invested doesn't remain constant because it keeps changing depending on inflow, outflow, when it happens, etc.
The capital that you deploy is not the same.
Yes, and therefore, because it's not the same, and the time frame for which each of those capital deployments have happened are different from each other, it's important to be able to understand that if I want to look at rate of return, it would be unfair to compare some investment that I made 5 years ago with some investment which I made 1 month ago, because the outcomes could look very different.
So this gives you an internal rate of return, essentially maps out what you have earned for each installment of your investment, calculates all of that together and gives you a blended rate of how all of your investments have performed. So if you've got, suppose, a 12-month SIP, it'll calculate based on the rate of return of each of those installments, what is the blended rate on an annualized basis.
That's
correct?
right. That's right. So that's what it'll do. And it'll also do one more thing, which is that when you have outflows, it will also account for that.
Yes.
Because it's easy to account for inflows.
Yes.
You also need to account for outflows because that's how life is.
Yes.
And this is very different in in mutual funds as compared to, say, real estate. In real estate, traditionally, you've bought something and then you've sold it.
Yeah.
But if you think about how do I account for the rentals that I make on real estate, then those are also cash flows. And therefore, this tries to make it similar, though everyone tends to talk in absolute numbers and says, you know, I invested 1 crore, it became 2 crores.
That is the point, and everyone tends to also talk in terms of point-to-point returns. So they say, and look, the tendency is for all of us to do that. Ultimately, we're reaching the end of the year. We will look at where the Nifty 50 was at the start of the year and we'd say, okay, 14% growth, fantastic. But the thing about it is, and this is very interesting, you might actually notice, by the way, in case you invested in the Nifty 50 at the start of January and you've gotten 14% on what you invested in January. But if you had, for example, hypothetically, an SIP running in an index fund, you might actually notice that your XIRR is actually more than 14%, potentially, or it's yielded you more than 14%. And the reason for that, Vishal, hypothetically, is that on the days in which you have deployed or that SIP has come through, the Nifty 50 would have been lower than it was in January at those periods of time. So you've accumulated larger number of units on those days, correct?
That's right, absolutely. So that's the most common reason. In fact, let me try to illustrate this with a very simple example, even for long-term investors besides the one-year investors. So let's say you 5 years ago invested 1 lakh rupees into a particular fund.
Yeah.
And then at the end of the second year, you decided that I had another 50,000 rupees to invest.
Yes.
And I invested that. And today the value of that investment is 180,000.
Right.
Now, in the traditional point-to-point absolute return thinking, you would have said, I have made 80% return.
Yeah.
Right? Because you would have mapped it saying 100,000.
Yeah.
Then you would have forgotten that I put in this 50,000 along the way.
Correct.
And you would have got some number. Now, if you actually built an XIRR on this, you'd find that your annualized return is about 11.5%.
Right.
And therefore, it's so important to account for time flows of money, because ultimately the whole thing about personal finance is 101 is basically about time value of money.
Yeah.
And that's what you're really accounting for here.
Yeah, absolutely. And so, therefore, of course, it's a good thing if you're, if you look at your screen and if it's positive, it's certainly something to smile about. But then understand the XIRR as well. And the best way, of course, to deploy funds over the long period is to look at the SIP, because when the markets are down, when the chips are down, you're actually using the same amount of money and you're deploying the same amount of money. And what that means is that you are buying more units in that month than you bought in the previous month, which is always a good thing. So more bang for your buck, especially over the long period. Do you agree?
Absolutely.
Okay. Let's talk about Factsheet, because this is an interesting one. I think there's so much information available. What do you look for when you look at a Factsheet?
So I think, it is probably that one tool that all investors have access to, which is very, very unused in our experience. I think most people think about it as, as some attachment somewhere, which I don't really need to look at.
Yeah.
And our experience has been that it's a treasure trove of information.
Yeah.
And it's kept getting better and better over a period of time, because either regulators have forced that to happen, or funds themselves have realized that, the more they disclose, the better it is for the end investor and the type of investor they bring into the scheme.
In fact, while we're speaking about it, we've decided to take the Parag Parag Flexi Cap fund as an example and look at how the fact sheet of Parag Parag looks. So we'll pull that up on the screen so that you can take a look at it. Of course, I don't expect you to really read that. I can't read it myself, but this is what it looks like. So while we're talking about it, I'm going to ask you, Vishal, to look at the screen perhaps and indicate broadly the kind of information that is available to an investor. And in fact, let's zoom into the screen further. Let's talk about it.
So I think there's, some very, very important information built in.
Yeah.
One is the fund manager track record.
Yeah.
Who all are managing the fund.
Yeah.
And what you can see there is, typically in the case of Parag Parag, you will see 5 names coming in there.
Yeah.
Why do 5 names come in there? It's a Flexi Cap equity fund.
Yeah.
You would have thought there might be one manager.
Yeah.
But what it's doing there is it's actually showing you that there are different people managing different components of that portfolio.
Rajiv Thakkar, Rona Konkar, Raj Mehta, Rukun Tarachandani, and Mansi Karya.
That's right.
Yeah.
And they're doing different things there. So someone's looking at the overseas component, someone's looking at the India component, someone's looking at arbitrage, etc.
Yeah.
The second thing that you get there is information about what are the kind of holdings that they have. How much of their portfolio is equity. For example, 66% of their portfolio is in equity.
Yeah.
about 21% is in a combination of debt instruments
Yes.
and cash-like instruments.
Yeah.
They have about 12.5% of their portfolio in international equities.
Right.
So all of this information is available to you in the fact sheet to be able to see which stocks are they invested in,
Yeah.
which sectors are they invested in, what's the kind of portfolio turnover they have.
What is the turnover?
So it's 22% if you consider everything, including the arbitrage positions.
But what does it
Otherwise, it's only
indicate to you?
12%.
What is the turnover ratio?
This particular 12% indicator, for example, is a indicator that they don't churn the portfolio too much. So they are long-term investors themselves.
Yeah.
And in fact, one of the things that you will see across their fact sheet communication is the desire that they have that everyone coming into their scheme has at least a 5-year view. And that's because they themselves are building portfolios keeping that in mind.
Yes. You have quantitative indicators as well.
Yes, a lot of risk ratios are built in there. You have a Sharpe's ratio, for example. A Sharpe's ratio shows you how much risk was taken to generate what kind of return that they generated.
And less than 1%, less than 1 is good.
So typically the higher the better. So the more you get of it, the better it is. But essentially what you want to be able to try to do is when you're comparing different schemes, you might find that there's one particular scheme which has a fantastic rate of return.
Sure.
But it may have taken a disproportionate amount of risk to generate that return. And therefore you take two Sharpe ratios and compare them and say, okay, on a risk-adjusted basis. A lot of people talk about risk-adjusted basis, right? But how do you quantitatively look at this?
Okay,
Comes from a fact sheet.
In this case, you're talking about a Sharpe ratio of 0.85.
Right.
What you're essentially saying is that in order to get this kind of return, which, and I'm trying to pull up the return over a period of time, if we're talking about 28.56% on a 1-year basis till November, we're talking about a Sharpe ratio of 0.85. You're saying somebody would have similar return, but a Sharpe ratio of 0.65. That would be worse off than Parag Parikh's Flexi Cap?
Yes. So typically what the Sharpe's ratio tries to do is tries to look at risk-free rate. How much did you generate over a risk-free rate?
Right.
And what was the kind of standard deviation of volatility taken to deliver that? So as an investor, one of the biggest challenges investors face, not so much in upward trending markets, but clearly when markets go down.
Downside protection.
Is what happens when markets correct and they panic. So what you want to do is you want to see funds which have low standard deviation, which can actually then help with the Sharpe's ratio being higher.
Okay.
So there are many such ratios also built into the fact sheet. In fact, just on returns, you can find that there is multiple types of representation of returns as well.
Yes.
You will see there's trailing returns, you will see there's performance against the traditional scheme benchmark, then you can have an additional benchmark like the Nifty 50. You can look at rolling returns over different periods. So these fact sheets have so much information in them that I think they're really, really important when investors look at what decisions they're making. And they become even more important at certain times when things don't do well.
It's giving you also you were talking about different types of returns. Parag Parikh, for example, I'm looking at the third page of the disclosures on this, and there you go. See, you have lump sum investment performance compounded annual returns over a period of time since inception for a 1-year period, for a 3-year period, for a 5-year period, and for a 10-year period. If you scroll down further, you see a rolling return for a 3-year, for a 5-year, and for a 10-year period. And this is very significant because we spoke about XIRR, which is internal rate of return. A rolling return is slightly different from that. Why is rolling return important?
So I think the most important thing you have to imagine is you have to think about this like, say, a cricket match, right?
Yeah.
So, why is Virat Kohli such a great cricketer?
Yeah.
He's a great cricketer not because he's always done well in Australia. He's a great cricketer because he's been very consistent.
You're looking at the scorecard today.
Yeah, so that's the challenge of trailing returns, right? You look at the last performance or the last 3 performances and don't feel good about it.
Sure.
But essentially what rolling returns does is it averages out your performances over, say, 6 months, 1 year, 3 years. And therefore it actually demonstrates consistency.
Yeah.
And that's what makes Virat Kohli a great batsman, that he's consistent, though there will be times where he will do, not so great. And there'll be times when he'll do spectacularly well.
You need to have a certain amount of time that you've spent managing a fund in order to have those longer rolling returns, right? And so therefore, newer funds don't have the advantage of showcasing their performance over a period of time, which is why something like Parag Parikh, which has been around for a while, has that 10-year rolling return.
Absolutely. It's very important. And it also, I think the other thing that people need to look at in fact sheets very carefully is expenses.
Yes.
I think
the expense ratio.
The expense ratio, right?
Yeah.
So it actually discloses what it is for a regular plan, what it is for a direct plan. It also, very often you'll find that funds that have lower expenses are also great believers in low portfolio turnovers, because the more you turn over stocks, the more your expenses also go up.
Sure.
And therefore, a lot of these things are, if someone's telling you something and you want proof about it, take the fact sheet and listen to the commentary and see whether the language is exactly the same.
By the way, in case you've been looking at the fact sheet, if you're an investor and you have been an investor in the Parag Parikh Flexi Cap fund over a period of 4 years, then you will have noticed right on the first page where they talk about the allocation to international equities, to cash, various other things. Vishal pointed this out, 12.5 odd % in international equities. This was 28%, close to 30% about 3 or 4 years back. As a result of the change in the regulations that govern the mutual fund industry's allocation to international equity, they've had to bring it down over a period of time. This is not something that they've done through selling. They've actually kept their international holdings unchanged, but incremental flows have all gone into domestic institutions, and also, of course, as we've seen and as you can see on your screen, into debt assets and into cash. I want to talk about that as well, Vishal, because a lot was said, a lot has been said this year in particular, and I think anytime you have a romping bull market the way that you've seen over the last 7-8 months, of course you had a bit of a hiccup. In the run-up to that hiccup, you had a few more people saying, why are mutual funds, why are fund managers taking cash calls? Parag Parikh openly said, look, we're uncomfortable with the valuations as they stand right now, and we are taking a significant cash call. And we're talking about 15, 18, 20% of a cash call, which currently exists as well. The proof is in the pudding. The proof is also in the data, in black and white, and they have actually managed to stay positive September to now.
Yeah, I think it's a great point, and I think this is where investor education is really important.
Yeah.
So there are two sides to this conversation. One is that, should a fund manager take cash calls?
Yeah.
For example, if markets are overvalued. The reason why Parag Parikh may have done so is because they're believing that, it's their responsibility at their portfolio level to manage risk in a certain manner.
Yes.
And of course, a part of the reason why they might actually have positive performance may also be coming from the composition of their portfolio.
Yes.
Because that 12.5% international equity has actually done quite well for them, because international markets have done better than India has done. So keeping aside the Parag Parikh example, the reason why a lot of fund managers don't take cash calls is because they're saying that we have no view on how much cash calls investors themselves are taking. So let's say an investor had 10 mutual fund schemes on equity in their portfolio. And because they got uncomfortable with valuation, they went ahead and removed, 6 of them.
Yeah.
And they were left with only 4. So they've actually taken a cash call already.
Yeah.
And then their fund on top of that takes another level of cash call.
Which is the problem.
Which is the problem, right?
Okay.
So I think there's no perfect answer to this. I think different managers will take different approaches. I think what's important for investors is to try to figure out what works for them as a strategy. And obviously at different parts of the market, you will look very smart if you have cash, or you look rather stupid if you have cash.
So, but I do want to draw your attention to some data we pulled up, and we often compare Parag Parikh Flexi Cap Fund, we compare Quant as well. So let's pull up the portfolio disclosures for the month of November compared with the month of October, and how the portfolio has shifted. Very quickly run you through all of this. Domestic equities has actually fallen, as we pointed out for Parag Parikh, to 66.8% from 67.7%. Cash has fallen, yes, but you will notice that the certificates of deposits, let's pull the next slide up. Certificates of deposit now stand at 5.2% compared with 3.7%, and so that's where incremental monies have gone through. Compare that with Quant. It's deployed all of its cash and cash equivalents in the month. It had 8.8% in October end, and it has deployed all of that entirely in the month of November. It has gone up to a domestic equity of as much as 94%, so practically entirely deployed. Now, let's also very quickly run you through some of the new additions that Parag Parikh has made. Very small additions, so we won't spend too much time with it. Those numbers and those names are flashing on your screen. One complete exit in the form of IGL, Indraprastha Gas, and not too much to speak of. You have Quant that has added a few as well, and again, not very substantial additions. Let's pull that up as well. One fresh exit in the way of emphasis. Let's very quickly pull up those data points. Yeah, so there you go. Added positions in Jio Financial Services and Reliance Industries. Now, I do want to talk to you about some of those calls because you said the constitution of the portfolio matters. The reason why, and let's pull up the comparative chart if we can, of the performance of the Parag Parikh Flexi Cap fund and the Quant Flexi Cap fund compared with the benchmark. The reason why one is going south and the other is positive is because of a very large position in Reliance Industries, 10%. And that's a very significant holding to have. It's so important, therefore, to look at the fact sheet going back to our earlier conversation. But what do you make of this strategy?
So I think, every fund house and every fund manager takes different views in terms of the length for which they want to buy a business. So say a PPFAS might be thinking that I want to buy businesses with a 5-year view.
Yeah.
Quant may be thinking that I'm happy to take a tactical view on a stock, maybe over the next 1 year to 3 years, if I believe that those valuations are attractive. Now, what tends to happen with buying at an attractive valuation is that you have no way to know whether you will actually end up, seeing that price go down further immediately after you've bought, or whether it'll actually go up right after you buy. And I think that's where, investors need to step back and ask themselves, saying, how do I not worry too much about 1 month, 2 month, 3 month returns? Also, how do I not worry too much about which stocks to buy as a fund manager? Because that's why I'm paying them. It's their job, because I don't know whether I should buy Reliance or not. I'm paying the Quant fund manager to do that job.
And for all you know, a lot of people have talked about the fact that it's been beaten down. It could well turn, and that picture might be entirely different in April of next year.
Absolutely, and that's why it's important to have conviction in the fund manager. Do whatever research you want to do before you put your money in, but then don't try to question every call of the fund manager, because that's the reason why you went to an active manager. You did your due diligence, you looked at those fact sheets, you looked at the data, you looked at the risk ratios, you looked at everything. And you said, okay, I'm confident of putting my money in
What
there.
will be interesting is if a fund manager has consistently said that I completely deploy funds. And if one fact sheet shows, oh, there's a buildup of cash, that should be a red flag for you, effectively.
I think you need to look at it consistently again, because what ends up happening is sometimes cash can also come just because of inflows and outflows. And sometimes it could be that you're exiting a large position and buying something else. And the month end comes in the middle. So you have some of those things. So there are some nuances that one needs to keep in mind. But consistently looking at the fact sheet is very important.
Thanks so much, Vishal, for joining me. Pleasure having you on the program.
Pleasure.
And well, that brings us to the end of this particular edition of the Mutual Fund Show. Let us know what you think. Lots more coming up over the course of the day. And this is NDTV Profit.